Okay, so this analysis report lays out a very bullish case for a $6 price target on Sealsq, LAS. It's all driven by that huge preliminary Q3 revenue growth, 41% year over year, and some, big strategic catalyst launches in quantum safe tech. So let's just jump straight into how we can make this thesis even more robust.
Yeah, the starting point is excellent. I mean, it confirms all the headline numbers, that 41% growth, Q3 revenue being more than the entire first half of the year combined, and management's reaffirming the high end of guidance. That creates a really compelling argument right out of the gate. But we need to make sure the strategic justification is as powerful as the numbers are exciting.
Right, so where do we start? I think maybe with the most stabilizing factor here, the cash position. The analysis report notes the company's sitting on around $220 million in cash.
And that figure is absolutely central, which brings us to, I think, our first major point. While that cash position is noted as a risk mitigator, the analysis really should be integrating that $220 million pile much more actively into the offensive growth narrative.
I see, so it's about the framing. I mean, I get the instinct to highlight stability. The report frames this cash mostly as a defensive tool, right? It says it reduces bankruptcy risk significantly and provides runway while competitors die out.
Which sounds safe, and it is. But for a high-growth valuation, that framing is actually a weakness. $220 million is, it's enormous relative to their market cap, especially when you're forecasting, 59% to 82% annual growth? By calling it just a runway, the analysis is really understating the strategic power of that asset. It suggests the cash is just sort of sitting there,
waiting for things to happen, rather than making things happen.
Exactly, making things happen.
But, couldn't you argue that talking about M&A or aggressive spending introduces new risks? Maybe the analyst is trying to avoid speculation and focus on the company's discipline.
That's a fair point, but if your goal is to validate a $6 price target, discipline alone just won't cut it. So the suggestion here is critical. You have to reframe the cash. It's not a safety net. It's an active tool for aggressive expansion. It's not ballast. It's ammunition.
Okay, ammunition. I like that. So if we treat it as ammunition, what are the concrete examples of how you'd load that into the growth story?
Okay, first, you have to connect the cash to non-organic growth. Explicitly. The analysis should dig into how that cash could be used for acquisitions. Similar to how well they integrated iCalps. That kind of move accelerates growth instantly.
And it shows they have multiple levers to pull to hit that 59 to 82% growth. It's not all just on organic sales.
Precisely. And second, R&D. You have to discuss how that cash pile lets them just outspend everyone. It secures their lead with the new QS7001 chip and the CNSA 2.0 compliance. It creates a funding moat, a financial one. Smaller competitors just can't keep up.
That's a great way to put it. A financial moat that protects the technological moat.
Highlighting that number is such a tangible way to show how undervalued the core business is. It shifts the whole mindset from, this is a safe company, to, wow, this company is offensively cheap.
Yeah, that metric would be a jolt to the reader. It creates a much stronger, more urgent call to action. Okay.
It's the foundation for that aggressive target.
Let's use that idea of the moat as a segue into our second critique. The report leans very heavily on two big catalysts for future revenue.
Right, the quantum chip compliance and the new U.S. root of trust facility. And they are absolutely compelling. They're the heart of the bull case, especially for those, high-margin government contracts. But this is where we hit critique too. These catalysts are presented as features, but the analysis needs to quantify how they function as, insurmountable barriers to entry for competitors.
Okay, the report does identify these two events, the November 25th chip compliance and the November 21st facility launch, as creating a massive moat.
It does. But massive moat is a conclusion, not evidence. That's the weakness. It fails to explain the magnitude of the difficulty, or, the actual time lag a competitor would face to get the same CNSA 2.0 compliance or build out their own U.S. infrastructure. We need to detail the components of that moat.
That's a critical distinction, yeah. If a competitor can just replicate this in 6 months, the moat kind of vanishes, and so does the long-term justification for the price target.
Exactly. So the suggestion is to strengthen the argument by really detailing the practical implications of these advantages. Quantify the competition's pain points,
But how do you do that without just speculating? I mean, is it even feasible for an analysis report to estimate competitor timelines for something as complex as CNSA 2.0 compliance?
You don't need their proprietary data. You use proxies, you find context, you provide information on the typical timeline or cost for any company to get a similar, complex hardware certification. You establish the industry norm. This stuff is measured in years, not months. You talk about the cost of failure, resubmission, the audits.
So you're framing it as a multi-year regulatory lockout?
That's the phrase, absolutely. And then there's the other piece, the U.S. root of trust. This is a big one. The analysis mentions a $175 million revenue pipeline for 2026 to 2028. You have to explicitly connect that pipeline to this new facility.
That link is vital. You have to spell out that this domestic government-vetted infrastructure is the non-negotiable key to unlocking those specific federal and defense contracts.
Right. It's not just about compliance. It's about physical, sovereign location and authorization. If you're issuing digital IDs for, say, federal agencies, you have to be a trusted U.S.-based entity. That's a sovereign barrier to entry. It takes years of auditing and relationship building.
And finally, you could leverage the timing. Frame that QS 7001 compliance as a real first-mover advantage. It lets them capture all those key early contracts while rivals are still stuck in the regulatory mud. It basically guarantees them the initial high-margin business.
And that urgency, that market capture potential, it makes the premium valuation so much more defensible. The revenue gets locked in before the competition even shows up.
Okay, so that technical and regulatory depth is what really elevates the report. Now, let's shift to the financials, because there's a huge, sort of unaddressed assumption in the path to hitting that guidance.
The momentum?
Right, the Q3 revenue of $5.1 million is impressive. It's more than the entire first half of the year.
It's phenomenal momentum, but this is where we have to look really closely at the model. And this is critique 3. To fully validate the high end of that $6 target, the analysis has to provide a much clearer model for how the company achieves the massive sequential revenue growth required in Q4.
The math is, it's startling when you do it. To hit the high end of the guidance, $20 million, Q4 revenue needs to be $10.1 million. That's because the first 9 months were $9.9 million, so they have to double Q3's breakout performance in 1 quarter.
And that doubling is the key vulnerability in the financial bridge right now. The weakness is just relying on management saying, we reaffirm guidance without showing the math for how that happens in 3 months.
But hold on, doesn't the success of Q3, that 41% year-over-year growth, imply a smooth, accelerating trajectory? Why do we need a separate model just for Q4?
Because Q3's growth had different drivers. It was partly the IC'Alps acquisition and a rebound in legacy semiconductor demand. Q4 growth is different. It relies almost entirely on the execution of brand new catalysts that are both happening in November. The QS 7001 starts shipping, the root of trust opens. We have to know if that $10.1 million is a smooth ramp or if it's dependent on a few huge, lumpy contracts being recognized right at the end of the year. That changes the risk profile completely.
I see. So the suggestion is to build a scenario analysis that explicitly links Q4 growth to those catalyst timelines. Move beyond just repeating what management said.
Yes, give the reader the roadmap to that $10.1 million, and we can make it tangible. Create something like a hypothetical Q4 catalyst waterfall. You map the launch of the chip in November and the opening of the facility to immediate Q4 revenue recognition.
So, are we talking about things like initial high-volume defense pilot orders coming through in December, or maybe immediate licensing fees from the root of trust opening?
Exactly that. Be specific. If the jump comes from a smooth continuation of their existing business, the risk is lower. But if it relies on pulling forward massive contracts from that $175 million pipeline, the analysis has to say that. Because that revenue is binary. It either happens or it doesn't.
Right. And addressing that risk is just as important.
Oh, absolutely. The analysis has to tackle that risk head on. If those key government contracts slip by even a week, say, into Q1 2026 because of some final bureaucratic sign-off, the entire thesis for the high end of that guidance just falls apart in the short term.
And the valuation would immediately default to the lower end, the $17.5 million guidance, which is a fundamentally different story. Acknowledging that sensitivity makes the whole report more credible. It shows you've anticipated the skeptical questions.
By building that explicit Q4 model and talking about the specific contracts they need, the analyst turns a huge assumption into a defensible forecast.
Okay, to sum up, this analysis report is built on a very strong foundation. You've got the 41% Q3 growth, a validated $6 price target, and that incredible cash position. The bull case is definitely there.
Yeah, our goal was just to make that bull case airtight. So we focused on 3 main opportunities to really strengthen the arguments.
First was reframing that $220 million cash pile, moving it from a defensive safety net to an offensive growth weapon. So detailing its potential for M&A, for R&D, and using that enterprise value metric to hammer home the undervaluation.
Second, we said the analysis needs to quantify the barriers to entry. Don't just say massive moat. Give the reader hard evidence, timelines, cost proxies, something that really establishes that long-term high-margin advantage from the Sealsq compliance and the U.S. facility.
And third, closing the loop on the financial logic. Building a clear Q4 scenario analysis to justify that required $10.1 million in revenue. Connecting that huge sequential leap directly to the November catalysts, and importantly, addressing the risk of any contract slippage.
Right. You implement those 3 suggestions, and the justification for the $6 price target goes from persuasive to really indisputable in its rigor.
We look forward